Uncertainty and volatility are the hallmarks of the stock market in 2024, especially with the arrival of October, a month historically associated with major declines. When it comes to the October effect, the expectation that this month will bring a dramatic drop in the markets already creates psychological tension among investors. This phenomenon is not purely speculative. From 1929 to 2008, major crises occurred in this period, and this creates negative anticipation that can trigger mass selling and panic. In 2024, with the memory of these events, many are preparing for turbulence. What's interesting is how anticipation itself can become a self-fulfilling prophecy, making October an emotional minefield that investors need to navigate with extreme caution. In addition to this psychological impact, the global geopolitical landscape adds an extra layer of uncertainty that cannot be ignored. The world is literally on fire, with the war between Ukraine and Russia intensifying and conflicts in the Middle East, such as Iran's involvement in the conflict between Israel and Hamas, amplifying concerns about military escalations. What makes 2024 particularly dangerous is the potential for nuclear escalations, especially with Iran getting closer and closer to achieving nuclear status. These conflicts not only affect the prices of commodities, such as oil, but create a risk-averse environment, driving investors away from riskier assets and pushing them to the safety of bonds and other defensive asset classes. However, what really accentuates the risk for markets this year is the proximity of the presidential elections in the United States. With a close race between former President Trump and Vice President Harris, there is immense uncertainty about the future of fiscal, regulatory, and international policies. One of the biggest fears is the potential taxation on unrealized gains for extremely wealthy individuals, which could trigger massive stock sales by these investors to cover their tax liabilities. On the other hand, a Trump victory could mean cuts in corporate taxes and deregulation, which could spur a bull run. This uncertainty makes the market volatile, with each new electoral poll impacting the indices in real time. Added to this, we have the impact of the Federal Reserve's monetary policies. In 2024, the Fed has adopted a softer policy, with interest rate cuts to try to avoid a recession. However, there is a dilemma here. While the stock market generally responds positively to rate cuts, the reality is that these reductions can be a sign of economic weakness, especially when the labor market is fragile. With each new unemployment data, the markets adjust. If unemployment numbers rise beyond expectations, investors may anticipate further cuts while also fearing a recession. The current scenario calls for extreme vigilance, as economic signals can quickly reverse. The risk does not end there. Technology, one of the drivers of the market in recent years, is also facing its own challenges. Despite having led the rally for much of 2023 and 2024, big tech companies now face a potentially harsh correction following the Fed's rate cuts. History shows that the tech sector tends to underperform in the months following rate cuts, especially if the market starts to anticipate a recession. For investors who bet heavily on these stocks, the risk of a significant correction in the coming months is real. This creates a sense of vulnerability, where any negative news can be the trigger for a wave of sales.
With